Greetings. Just 1 month ago, we saw Silicon Valley Bank collapse because the Federal Reserve has created an inverted yield curve, which affects all banks adversely. Silicon Valley Bank had the added problem of most of its clients being tech companies and the tech industry being in a correction simply because it was below its all-time high, although still far above the 2019 level. That is the flaw in our system. Now, just 1 month later, another bank, a larger bank, First Republic Bank, is on the verge of default and FDIC takeover for the same reason, an inverted yield curve. This is First Republic Bank's stock price and dividends reinvested, so its actual stock performance is better than this line. But nonetheless, it was a steady, stable business that was rising pretty well, and everything was going fine until the extraordinarily distortive money printing that the US Federal Reserve did. Money printing was needed, but a far more diffuse and direct form of money printing, as I often speak about, and that created this type of artificial high. Now, it cannot stay at this high, but at the same time, this high was so artificial that any deprinting would cause a regression back. And the deprinting results in a negative yield curve. And that is why, rather than merely return to this pre-COVID status quo over here, the bank collapsed. We have a systemic problem when any decline from an all-time high, when that all-time high was entirely artificial, causes bank collapses. Now, to study everything about why the Silicon Valley Bank collapsed, see this video in the upper right-hand corner. I don't want to repeat all the same points. But now we have the same problem with a bank that is larger and far less concentrated in the technology sector than Silicon Valley Bank was, First Republic Bank. It has plunged down to this share price, far below what it was even in 2010. Everything was going steady until our system got stretched because the Federal Reserve prints money in the form of buying treasuries and mortgage-backed securities, which allows banks to make a huge amount of money while the Federal Reserve is doing money printing, but also puts banks in a position where any deprinting is not sustainable and the banks collapse. Also, why is the Federal Reserve raising rates at all? Inflation is not high, as you can see from this video up here in the right-hand corner. And whatever little blips of inflation there were not even because of money printing, but it was because of oil being made artificially high by the Biden administration obstructing U.S. domestic fracking, and more significantly, the war between Russia and Ukraine, which the U.S. military-industrial complex has also engineered for financial profit. So whatever temporary inflation there was is not only over, but it was not even because of money printing. But because our system is set up in this way and these PhD economists are hyper-theoretical and don't understand that it's a lot worse to make banks collapse than to have eggs cost slightly higher than normal for a short time when they're going to return back to their normal price anyway and already have. It's really quite insane because we have a fragile system and the money printing versus deprinting decisions are made by PhD economists who are hyper-theoretical. They really have no comprehension of how the actual economy in the real world works. They think the way to halt inflation, which isn't even there, is to make people lose their job because PhD economists, of course, think that if someone's job goes away, then all of their expenses stop. And I've made many videos about this, but that has caused now this next shoe to drop, which is First Republic Bank. And this bank has failed because of this inverted yield curve. So let's look at what the yield curve looks like. This is the 10-year Treasury minus the Fed funds rate. And in a healthy economy, this would be 2 to 3%. But because we are in an age of exponential technological deflation, the 10-year yield, which is somewhat more freely traded despite the quantitative easing trying to pressure that, is actually lower than the Fed funds rate. The 10-year yield is about 3.5%, whereas the Fed funds rate is almost 5%, and that is why we have this inverted yield curve. We had a similarly inverted yield curve in the 2007-2008 period, which led to that financial crisis. And this is even more inverted than it was at that time. Now remember what I said in this video up here about the problems with an inverted yield curve, and how this is deliberately created by the Federal Reserve because their understanding of the modern economy is from textbooks that are about 50 to 70 years out of date, and therefore they have no comprehension of why money printing does not cause the inflation that they assume it's going to cause, but they act as though inflation is already a given, even though they have been wrong every time they predict this. So they raise the Fed funds rate to an excessive level in too short of a time, and they create this negative yield curve. And remember that if the yield curve is negative for only a week or two, nothing happens. But as it is negative for more time and to a greater extent, the cumulative pressure on banks to fail increases. A negative yield curve by definition causes banks to fail because the bank's entire business model is dependent on a positive yield curve. And the area enclosed below zero is a good barometer of this cumulative pressure on banks. Not that a zero yield curve is actually good, but just negative is extremely bad. Even +1 is pretty weak, but below zero is very, very bad. And that's why you have this type of situation of an increasingly negative yield curve for more time. Even in the last month, the area enclosed by the negative yield curve and the zero line is rising, and this amounts to cumulative pressure. In the last financial crisis, the area enclosed below zero was still less than what this looks like it's going to be. Let's go to this shorter 5-year chart. Even a month ago, we were up to here. Now we've added this much more area. One more month adds another wedge worth of area. Where will we be in yet another month or 2 months? All this pressure is building on the entire economy. When they bail out a bank, like they do with Silicon Valley Bank, the Federal Reserve has to print more money. So even their printing and deprinting is contradicting each other because they simply don't know what's going on. The solutions I have described in this channel would all have worked because they are more in tune with the modern economy and the fact that a software-heavy economy is disinflationary because software inherently generates technological deflation, which requires money printing to offset that deflation. That is described on many other videos in this channel. But as this area rises, the cumulative pressure increases and you will see more banks fail, just like First Republic Bank. And that was a bigger bank than Silicon Valley Bank and less concentrated into the technology sector. So this is spreading far more to the middle of the economy and much larger and more mainstream banks, including the big 4 banks, the ones that are called too big to fail. The crisis is on their doorsteps too. And the only solution is to actually lower interest rates and make this yield curve positive, and most importantly, print money by sending it directly to people, as I have advocated since early 2016, and all market forces are proving out that that's the only end game that's possible. But unfortunately, these PhD economists are very theoretical and will never ever learn anything, no matter how many times their existing theories are wrong. Remember, they're so theoretical that when reality contradicts the textbooks they've memorized that are 70 years old, they're more content to ignore reality than to question the textbooks. So they are effectively the flat earthers of modern economics. And if you like this type of content, I encourage you to subscribe to this channel, and thank you very much for watching.